It's like 99% of coins are scams.
Yeah, because it's really easy. It's really easy to spin up a coin.
I can make a coin.
Anyone can. I mean, make a coin right now. In the last the next 20 minutes. Let's get you guys the cloud accounting, the cap coin.
Cap coin.
Yeah.
There we go. If it doesn't exist, it could.
Yeah, could right now.
Somebody listening to this could make it and then start selling it.
Yep.
This episode of the Cloud Accounting Podcast was recorded at the Oracle NetSuite SuiteWorld Conference in September of 2022. To learn more about NetSuite and the SuiteWorld Conference, visit netsuitesuiteworld.com. Welcome to the Cloud Accounting Podcast. We are coming to you from SuiteWorld in Las Vegas. I am Blake Oliver.
And I'm David Leary.
And we are joined today by two very interesting people from a very interesting company. This is our second interview, and it's another company specializing in crypto.
We prefer the term digital assets. It's a little bit more professional.
Pat White, thank you for joining us. You are the CEO at Bitwave.
That's it. Thank you for having me. Much appreciated.
And we also have Rafael Casas, who is the VP of Business Development at Bitwave.
Great to be here, guys.
And also a huge fan of the podcast. He's been a huge supporter. He used to be at Oracle, and before that, I think he was at Sage. And before that, did you do a zero stint too?
No, not there.
You didn't get the trifecta.
No, not yet. I'm behind a few other of my colleagues on that one.
But you've been around a lot.
Intuit would have to be there.
And thank you for supporting the show.
Yes.
Of course, I love it.
All these years. It's been great.
Thank you also. We know that you lost your voice. It has come back to some extent, so thanks for being with us.
Thank goodness for green tea.
Fighting through it.
So let's just jump in. So I'm on your website. I'm on bitwave.io, and my questions can be like, what is Bitwave? Oh, you checked to make sure I was on the right site?
I'm just looking at the website.
So I clicked solutions, and it's like accounting, bookkeeping, pay bills with crypto, DeFi accounting, impairment, reporting and APIs, crypto tax tracker.
Yeah.
Like, that's a lot. Like, what do you guys do?
Yeah, so to put it really simply, like we started Bitwave with a really simple vision, actually, which was to enable digital assets for enterprises. So it's, if you think back, we started Bitwave in about 2018, and we kind of were, me and my co-founder are both enterprise software people. So we were not actually, I don't actually personally have an accounting background, although I do like accounting a lot. Like I'm a computer engineer, and there's an elegance to accounting that is not present in a lot of computer stuff that I really enjoy. So we can talk about that later. But so I'm an enterprise software guy my entire life, worked for Microsoft and Cisco and Intuit and a few other companies. And I'm also like a deep crypto supporter. I love crypto. I've been in it. I have some code contribute to the Bitcoin Core node. Like I've been in this forever. I love it. And so for me, I'm like, well, like, is there a way to bring together enterprise software and crypto? So we started a company that was setting out to enable digital assets for enterprises. And then it just so happens that as we were doing that, the very, very first problem that every single company we talked to using digital assets had was tax and accounting. So that's where we started, and we learned an incredible amount since then. And that's where you kind of get to the solutions tab there, which is there are tons of different problems you run into around crypto. It is not, I think people think that, you can kind of like, oh, it's just taxes. Like, oh, you just got to figure out your taxes for crypto and that's it. But really, there are complex accounting treatments that are kind of archaic in some ways. Like, we talk a lot about impairment, and I'm sure we'll get into this more. Impairment is it's a treatment for intangible assets. The only intangible asset, like I'd say 80% of accountants deal with on a day in, day out basis is like a domain name or something like that, which you would never impair. Like, how are you, like maybe the guys who started Enron, like a bookkeeper at Enron probably impaired Enron.com. That's maybe the one domain in history that got impaired down, but no one does it. So there are these relatively archaic rules that like a lot of bookkeepers don't actually know intangible asset treatments. They don't know about this stuff. So you end up finding people where, that if you want to be able to do US GAAP, so then that problem comes up. So that's how impairment ends up there. People are doing DeFi. DeFi accounting is incredibly complicated and no one agrees on how to do it. So that's how you end up with that on there. It's, but stepping back from all of it, we are here to enable digital assets for enterprises, and we have a full suite of tools for any sort of tax accounting, anything you need to do around digital assets.
And when you say digital assets, what's an example of a digital asset?
I know, I love it. We try to be professional. It's one of those things like when businesses grow up, you have to stop saying cryptocurrency and start saying digital assets. Anything. So Bitcoin's a digital asset, USDC is a digital asset, Bored Ape Yacht Club NFT is a digital asset. We have customers that have all of those things on their balance sheet and many, many, many more. I think right now in Bitwave, we track something like 20 million different tokens. there's just a lot of tokens out there. So all of those be considered digital assets. One thing I did learn recently, or even actually to sort of expand it slightly, you're also even seeing carbon credits are now turning into digital assets. So carbon credits are super interesting because they follow the exact same accounting treatment as digital assets. They are an intangible asset that you keep on your balance sheet. You have to impair down. And more, we're seeing people doing carbon credit trading on the blockchain. So now, I wouldn't call carbon credits a digital asset. I'd call them a ESG asset or something like that. But they're falling into our wheelhouse, and we're seeing people actually using Bitwave for them. So it's an interesting world we all live in now.
So are you just like a software solution? You're just moving data into the accounting systems? Or are you, I'm kind of thinking like a payroll service, right? They're providing some extra services. They're filing some tax forms for you. They have expertise in what you need to be filed or what needs to be filed. Like, are you kind of in like a little bit of a service company as well?
We are mostly an enterprise SaaS product. So we are mostly a piece of software that pulls data from the blockchain, does some manipulation on it, and it helps you push it into NetSuite, whatever ERP you're using, things like that. We have a solutions team that is some incredibly crack CPAs that also happen to be crypto degens. So like guys that, own random NFTs and love trading this stuff. So we have a group of people that really know this stuff like nobody else in the entire world. But we tend to not do that kind of service providing. And that's actually very intentional. So like one of the really crazy things about crypto is there's a lot of stuff that is settled, right? Crypto it's an intangible asset. It is treated for tax purposes as property. So you can kind of think of crypto as a Forex that you keep in inventory, right? So it's why QuickBooks and NetSuite, none of these guys can handle it, because normally in these ERPs you have either inventory or Forex. You can't really, if you're paying a bill, you can't pay a bill in widgets. And if you have widgets, you're not. If you have Forex, you're not really tracking the inventory on it, things like that. So we bridge the gap between those to allow you to handle it. But there's still so many things that aren't decided that we stay away from actually giving a lot of advice. It's something that's like kind of unique about us is that we don't give you advice. We'll tell you the 35 different options, and then you have to kind of make your own mind. So a great example, if we're getting deep into crypto, would be like, there's this thing called Ethereum. Everyone's familiar with that. There's this other asset called WETH, which is Ethereum when you wrap it in a ERC20 token. It essentially is a one-for-one. It is a smart contract on-chain guaranteed one-for-one wrapping action. There is great debate in the industry as to whether that's a taxable event or not. So like you could think of that.
I'm sorry, you said like 5 words there all together, and I understood maybe one of them.
Yeah.
So could you go back and explain?
Yep.
What are you're wrapping?
So you take an Ethereum,
Okay.
and you go to a smart contract, and you give that smart contract the ETH, and it gives you back this token called WETH that is you will always be able to trade it back for Ethereum. Like there is a very, very strong guarantees. The Ethereum network would have to break before I could not trade a WETH for Ethereum. So it's like you could almost think about it as like let's say you have a stock piece of paper, a stock certificate.
Well, it's like USDC, right?
It's like USDC,
Okay.
except it's even stronger guarantees because USDC you still have Circle that's holding it in the bank account, right? So if someone from Circle somehow steals all the money, the USDC token itself isn't worth anything, right? So
Right.
like it's even more guaranteed to have that ETH backing because it's all on chain. Like there is no one that can move it. It's all controlled by the smart contract.
So the Ethereum that I trade for my WETH,
Yep.
it stays
It stays in that smart contract.
and nobody else can use it.
No one else. Well, anyone can, because it's all fungible.
Right.
So anyone can pull out WETH from that smart contract. It's not guaranteed to be your ETH in there. Anyone could pull it out, but you are guaranteed that if everyone in the world pulled all of their ETH out of that smart contract and you had the one last WETH, there would be one ETH in that contract, and you could give it your WETH and get your ETH back out of it.
Okay.
So this is sort of an interesting one because depending on which of the big four you talk to, they disagree about whether that's a trade or not. Like, is that a disposition? When I give that smart contract my ETH and it gives me WETH, is that a disposition or not? And about half the big four think it is, and about half think that it isn't. And so
Can I ask you just like why would anyone do this? Like what's the point?
the reason you do this is that ETH by itself. So what's happening, the reason crypto is so incredible, like I know you'll hear a lot of different reasons why people like crypto. And like you hear some people that take the real libertarian side of that, like, they hate the Federal Reserve and like burn down the whole world and things like that. And that's fine. Like that's a totally fine position to take. That's not my position. Like crypto is incredible because it answers the question, like let's say you take 100,000 engineers and you give them a real API for money. And I don't mean like Stripe, and I don't mean like, a bank that can do ACHs. I mean like you give people a real API where you can actually program money, what happens. One of the building blocks of that API is an interface called an ERC20, which is this token interface. So every token that you're familiar with, USDC, we just talked about WETH, Matic, all these different tokens adhere to this ERC20 spec so that any single building block that wants to use it can. So the reason, like Uniswap is such a cool protocol. It's an on-chain DEX, right? It's a decentralized exchange. The way it works is that it can you give it two different ERC20 tokens, and it doesn't care what tokens are. It knows how to use that interface, and you can give them any two ERC20 tokens, and it can create a trading pool between those two tokens. So one of the problems is that ETH itself is not an ERC20 token. So you have to wrap it to turn it into an ERC20 token to then be able to to be able to use all these building blocks that are out there. So it's a long way answer.
It's convoluted for sure.
So this brings me to one of my core questions about cryptocurrency, and I'm a crypto skeptic. I fully admit it. I'm a professional skeptic. I'm a CPA, as I'm supposed to be. And one of the problems I have with the crypto bros and the crypto Bitcoin maximalists and all that.
Yeah.
I want to know if you are one, by the way. But that's another question. What I want to ask now is, one of the promises of crypto is that we're going to eliminate the trust that is necessary between independent third parties in order to do a transaction. A lot of our financial industry is around these like trusted intermediaries. That's what a bank is essentially. They maintain the ledger, and the global financial system is all these middlemen. And crypto can disrupt all that.
Right.
Just connect us directly.
It's a great disintermediary middleman. Yep.
We don't have to trust each other to use cryptocurrency.
Yep.
But it gets really complicated. And so instead of trusting a banker, now I'm trusting you, Pat, who wrote the code.
Yeah, right. You're trusting the person who actually wrote the code.
Right.
And these thousands of engineers that are inventing money.
Yeah.
Right.
So what if there's a gap in the code?
As there often is.
And that's what we see is we cover the news, and every week I see some sort of crypto project got hacked and millions were taken out, or rug was pulled.
Yeah.
Or worse than hacks, it's just simple accounting errors. They're just careless. Like they went too fast. And it's just simple, stupid mistakes now. It's not even things on purpose.
Yeah. So how do you address that question?
I think there's a few different ways you can address it. So first of all, you can look at addressing it at the protocol layer. So more and more protocols are asking the question of like, hey, what if we do have some way to rewind transactions? And there's the thing you have to understand about crypto. People always do this with everything, right? You like to sort of think about groups of like people doing stuff as very homogenous, and like crypto's like that. Like when a lot of people think about crypto, they think about the crypto bro and the dude with his like trucker hat, like smoking a J, like this guy like telling you to buy and smash subscribe button and things like that. Like that's a part of crypto.
And for our listeners, Pat does not look like a stereotypical crypto bro. In his defense,
yet that's like wait till after the show's over. And so that's part of it. The other side of it, though, is these people. So, and I say like kind of one way to think about it is like there's people who think they're going to buy crypto and become a billionaire. And I think they did a survey that like 30% of people who buy crypto still think they're becoming a billionaire from doing that. And that's, again, like not to judge, like that's fine, whatever. There's this other side of the world. There are people that are looking at the marginal efficiencies. So you brought up the number one use case that I talk about, which is disintermediating financial institutions. So if you're going to go through this process of disintermediating Bank of America, like today, you can go and borrow money from a protocol called Compound for 3% interest, right? Which is significantly, if you go into a bank today to borrow money, you're going to be paying prime, which is what, 3% plus 6%, 5%. So you're gonna be paying 8 to 9%, something like that.
I was just talking to a banker who does accounting firm transactions, and he said they try to make 10% on every deal.
Yeah. So the question you ask is like, well, why is that? Well, Bank of America has 100,000 employees. They have office buildings in San Francisco and New York. They still run AS400s. Like I have never proven this, but there's got to be a dude out there who makes chips for AS400s like in his like living room and sells them for like $10,000 to Bank of America to run these like servers that are like literally from the 1960s. So you take all of those costs and you compare it to a company like Compound, which is 50 to 100 people that runs no servers, all of their code runs on the public blockchain. You as the user pay the fees. Like you as the user are essentially paying the maintenance cost for this supercomputer running your lending code and all that kind of stuff. So within that context, like the crypto bros get really hung up on decentralization and all of these like the deflationary aspect, decentralization, all these different like I wouldn't say it's not political, but it's ideological arguments.
Libertarian.
Religious.
Yeah, even religious.
Yeah, 100%
feels religious.
Yeah. The people who are pragmatic about this, they don't care about that. Like they see this world where you're literally taking a company and doing 1/1,000,000th the size of a company and being able to provide the exact same services. And what does that look like in marginal efficiencies and costs and all this kind of stuff? And direct, basically me being able to borrow money from you and get better interest myself than I get at a bank account. Because it's not like I get that. If I put my money into Bank of America, it's not like I'm getting 10%, like they're getting it. And so for those people, like there are people now looking at how do you do protocol level rewinds? How do you do better, lockout periods so that if you do find a hack, you can protect it. It's going to be it will absolutely be a progression that we get to, but it's not to think that Bitcoin is not inherently tied to a one-way door that you go through and every transaction has to be like that. It's just where we've kind of ended up today because a lot of the early adopters were a little bit more ideological about it.
Do you support more cryptocurrency regulation?
That's an interesting question. So my general answer to this is I like cryptocurrency a lot because you have people like us that are trying to do the right thing. Like we are genuinely trying to bring digital assets into the fold in terms of regulation and tax and all that kind of stuff. And our customers are also trying to do the right thing. Crypto has a release valve. Like you can't shut down Tornado Cash. You can do an OFAC. The Treasury can come out and do an OFAC sanction of Tornado Cash, but it is still out there running, and everyone in the world can still use it. So crypto has this natural release valve where it cannot be stopped. Like you can do stuff to make it harder, but you can't stop it. So regulation is one of those things that I actually think that we can come to a world with smart regulation for crypto, because if you go too far on the regulation for crypto, people just move to the Cayman Islands and don't give a crap what the U.S. says and do whatever the hell they want anyways.
Just like we get black markets for goods when they get, banned, right?
100%. And so crypto has that release valve. So I think that we should see more regulation. I think we should get more guidance on a lot of this stuff. I think it'd be great if someone came out and said that we should not be doing intangible asset treatment for digital assets. Like that would be, it's a module we sell, so I like it.
Yeah,
but
right.
Like,
you've built a solution for it.
We got a solution for it. So maybe I'm biased, but it's all that stuff will happen. So it'll
take a while. You're safe for a while.
Safe for a little while. Is it FASB moves slow?
FASB moves incredibly slow. Yeah, that's true.
Yeah.
You have time to get a lobbyist and to sway your way anyways.
You did make a good point, though, when the reservations that you had, because I had that coming from ERP, 20 years background of jumping into this space. And one thing that was really interesting and impressive to me is that the amount of people that came over from the Googles, the Facebooks, the Oracle, and they're really anti-Bitcoin maxi. Yeah. So, me building partnerships and speaking with these guys, they're not here to build or help anyone that's doing a get rich quick. They want to build real infrastructure, real utility, and really help businesses that have legitimate projects succeed. And so that's one thing that's been really impressive to me, that where I'm not speaking to these guys, like you're saying, smoking weed and head backwards, like I've got this cool idea. We're really speaking to legitimate players and good actors. And so that's impressive.
Yeah.
Well, tell us a little bit then, who are you working with? Who uses Bitwave?
We have over 250 customers at this point across the entire board. It's really easy to think about crypto again as a homogenous group. You're like, oh, there's this Web3 industry out there and it's all Web3 companies. It's actually this really interesting group of like tiny little micro markets that are out there. So the one that I love is my favorite is energy. Like energy is a huge market. One of our first customers was a company called Greenwich Generation, which is a power plant in upstate New York. And these guys aren't hardcore crypto people by any means. Like they are a set of guys that kind of got interested in Bitcoin, owned a power plant, and said like, hey, one of the this gets deep, but like one of the interesting things about a power plant is it takes 8 hours. You have to forecast your energy usage 8 hours ahead.
Yeah.
So you turn the knob, and 8 hours later, that's what you get at that point in time. So if you guess wrong, that means that you waste energy. So they had this thing where like you have this supply and demand delta between your energy. That goes for solar, it goes for wind. All the different renewables have this. They realized it really early. They said like, well, hey, half the time we end up having a surplus of energy. We just burn it off. Like it comes comes off as heat off of our generators. What if we pump that into a Bitcoin mine? So they bought a bunch of Bitcoin miners. They did I think they even did like a financing with somebody to pay for it, and then just pumped that into Bitcoin and ended up making it. And then now they've expanded that and they're doing it other places, and it's really cool. So you have energy companies are getting to this. All the solar companies are looking at it now. All the gas and electric companies, like right now, Exxon, Shell, all these guys are looking at, hey, can we take a Bitcoin, a little Bitcoin miner and a little power plant, put those in our fields, in our gas fields, and use the flare from natural gas to drive a power plant to mine Bitcoin. And hey, that's just a little bit more. That's CapEx to OpEx. I mean, honestly, like it's just a straight calculation at that point.
Well, and what I love about that is the criticism of crypto is that it's very wasteful.
Yeah.
It uses a lot of energy. But in this sense, when it uses the excess capacity, it actually encourages companies to create more capacity because they know that if they create it, they can sell it or they can mine it.
It's, without being too hyperbolic, like it's to me the way that we do actually get to sustainable renewable. Because if you spin up a renewable plant, you have this issue where you have this terrible supply and demand problem where solar has a great supply during the day and terrible at night and things like that. So the idea of cryptocurrency as a smoothing function to make solar plants and other like renewable plants more sustainable long term is a phenomenally good use case for it, where it makes them profitable and it makes crypto greener. Now, where you run into problems, of course, is like people using subsidized dirty power in China to mine Bitcoin, and that's terrible. I tend to think that those problems will solve themselves over time. Like the Chinese government is not a fan of using subsidized power to mine Bitcoin, so they are cracking down. There's incredibly severe punishments for doing that, and we'll just see that happen more and more.
So one of the promises of Bitcoin is this idea of like a limited supply.
Yeah.
Right. That's one of the features of it. But I feel like DeFi has undone that because now what is happening is you can create coins, an infinite number of coins that has, so you have an infinite supply of crypto. And how do you, with an unregulated or a regime that's impossible to regulate, like you said, they can just go abroad and people can use crypto anywhere in the world. It's impossible to stop it from going across the internet. How do you stop bubbles from building?
Yeah.
Like we saw just recently with the evaporation of $2 trillion, in market value.
It's absolutely crazy. Couple ways to sort of think about that. So the way that I always talk about crypto in general is crypto is a story about use cases. Like you can't clump all crypto together. Bitcoin is a designed currency, is a deflationary design currency, which is really interesting. Like it is a social experiment. I don't know what else to say about it besides that. It is a social experiment to design a currency that's deflationary. Not every cryptocurrency is like that. Ethereum is not deflationary. It is designed to be a relatively stable
it's like
supply.
Low inflation, right?
Low inflation. USDC is designed to be, inflationary like USDC, like USD. It's one thing you look at all these different coins and you analyze the actual use case around them. Bitcoin was designed to be incredibly conservative. The development of the protocol moves incredibly slowly. It is designed to be deflationary. It's designed to be an inflation hedge. Now, what's so interesting about that is that it hasn't worked great during this period of high inflation. And I joke about this a lot. I'm 38. I've never lived through a period of inflation in my life. So, and a lot of people who love Bitcoin are like my age. And so it's really interesting that we were all thinking about, we're all sitting here pontificating about deflationary and inflation-resistant instruments and stuff like that, where the world hasn't seen inflation for 30 years. I mean, there was like a little bit in 92, 93, something like that, but like not really, not 8% like we're seeing today. So it's crypto is it's a experiment at a grand scale. It is a social experiment first and foremost because it's human beings putting value onto this, and some of them will work. Like Bitcoin seems to be having sustainability, but it's designed to be deflationary. Then you will also have scams, and you just crypto is a caveat emptor to the absolute extreme. Like be careful.
So many scams. It's like 99% of coins are scams.
Yeah. Because it's really easy. It's really easy to spin up a coin.
I can make a coin.
Anyone can. I mean, make a coin right now. In the last, the next 20 minutes. Let's get you guys the cloud accounting, the cap coin.
Cap coin.
Yeah.
There we go. If it doesn't exist, it could.
Yeah, could right now.
Somebody listening to this could make it and then start selling it.
Yep. And there's use cases around this stuff. So you have to be kind of aware of that. But all that being said, it doesn't scams don't diminish from the opportunity that is here. I mean, like when KKR was sort of the biggest entrance recently, where they just announced that they're tokenizing $4 billion of their assets. That is a super interesting use case because this isn't tied to deflation or inflation. This isn't a currency per se. This is the idea that like a company like KKR that traditionally has, through hostile takeovers, their main liquidity option has been to take a company, sell off the piecemeal parts, and then that's how they're getting liquidity out of it. What if they didn't do that? What if they take companies, maybe sort of like mishmash them, mash them up, put some together, and then tokenize that, and then sell those for $10 a token to actually give retail investors access to KKR type instruments? I mean, it's kind of crazy. It's kind of far out there, but it is this great democratizing aspect of cryptos that could happen, and that's happening today. So
yeah. I do like to wonder, am I going to someday work for a digital autonomous organization?
Probably not. DAOs are one of those things. Again, like all these things are social experiments. What we've seen in our expertise, there was just a big lawsuit over this with it was a DAO called BZX that essentially one of the DAO holders who got scammed out of a bunch of money is suing the DAO, of which he is the one of the interpretation for DAOs in the US, if you don't have an LLC around it, is it's just a general partnership. And so he's suing the general partnership, which is he's suing himself and then whatever the other 10,000 people in the DAO for damages relating to him getting scammed out of it. This is going to trigger every DAO to like just do an LLC, and like they're going to approach normal businesses with maybe a slightly different governance structure. But even that, like it's a social experiment because no one has yet proven that everyone voting is a better social experiment than, for businesses than a CEO.
Right.
And in fact, we have co-ops. Like, REI is a co-op. Their employees vote. There's co-op grocery stores. They haven't taken over the world. Like voting has been around for a long time, and command and control generally works better for companies. So,
well, we just need to put an AI in charge of a DAO.
There we go.
And then that's the next Amazon.
Man,
right?
I'd give my job up to an AI.
Worked really well on Twitter, right?
Yeah, I forgot about that.
Well, I think some people might prefer working for an AI to working for their actual current, boss, right?
Yeah, I'd give up my job in a second.
Only in the big four.
I feel like actually a big accounting firm would be great as a DAO. You got to record your time against those projects. It could issue all the invoices. It could do everything.
Can we roll this back to like simpler terms and simpler use case? So with podcasting 2.0, in theory, Blake and I could actually we have the app Earmark. In the Earmark app, we could actually just have a Lightning wallet, and our listeners can send money to us through the Satoshi. So it's with 1/600,000th of
8 decimal points,
whatever of a Bitcoin, and they can send it to us. So then they're sending it to us, and then we could actually have that portion out. Some of it goes to our engineer, and another portion goes to somebody who made the artwork or what have you, or show notes, and so it all goes out there. So what's left in our wallet is ours. So we have to somehow record that in. Right, let's say we're huge and now we're on NetSuite, right? We got to put it into NetSuite.
Yep.
So what does that look like? Are you guys just taking the balance and making a journal entry? Is it do you help me facilitate changing my Satoshis into real cash when it goes on my bank account?
No, I love it.
Like, where's the real use case here?
Totally. Okay, so let's walk through that use case. So you're getting crypto as revenue, which is a great use case here.
Yes. Okay.
So you get crypto as revenue. What Bitwave's going to do is we're going to monitor the blockchain, and we're going to see that Bitcoin hit your wallet. So we say, hey,
so I've connected you to my wallet somehow.
Yeah, you put in the wallet address. You hook it up to your Lightning node. There's a bunch of different ways that it happens.
And you're not pulling away. You're not going to go swipe on my Bitcoin out.
Yeah, no, we can't. We can't do that. Okay. It's only the read-only side. Or you give us read-only API keys to your custody, read-only APIs to Coinbase. So we see the Bitcoin hit your wallet. What we do is we're going to fair market value it, and that's essentially what you're doing is you're setting up your book cost. You can kind of think about Bitwave as so we are a digital asset tax and accounting subledger. And what you are doing is you're building a subledger and then adjusting ledgers on top of it. So this is another thing where like you get into this stuff and like, I don't know, probably half the accountants we talk to or bookkeepers we talk to don't know what adjusting ledgers are. These are weird concepts that not everyone deals with on a day-to-day basis. So you're building up a base ledger. So in this case, it would be debit digital assets, credit sales, right? Nice and easy. We'd fair market value it. So we're going to fair market value the Bitcoin, debit digital assets. Let's say it's 1 Bitcoin. So today is $20,000, $20,000 debit digital asset credit sales. We then are also going to take that Bitcoin and add it into an inventory. So Bitcoin is for accounting purposes, it is a Forex that you inventory. It's the best way to think about it.
And Forex meaning
Foreign exchange, yeah. So it's a foreign currency that you inventory. So mostly when you do foreign currencies, you do cost averaging, or like you're just looking at like different deltas between invoices. And this is it's a foreign currency you have to track on a lot by lot basis with inventory.
And that's that ledger that you're talking about. It's every lot that has been sold or bought.
Exactly. So every time
2,000 listeners each send us $8 a piece.
Yeah.
We have to record.
That's a
That's
row.
2,000 lots that
and
we
then
would
what if
track.
they're paying us per minute listened? And there's a lot. It's even teener because that's the beauty of this. It's microtransactions.
Microtransactions.
So you have to track each one of those separate lots.
We have customers doing 100 million transactions a year easy. It's crazy. So what we
would
would
summarize that into my ledger,
we would
detail?
tend to do roll-ups. So we would do hour by hour roll-ups or something like that. Like we would not track individual at that level. It depends on what your auditors want. Like this is every question in crypto is it depends, right? It depends what your auditors want. Depends like what you guys think. But for the most part, if you were in that situation where you're getting that much, we would roll it up on an hourly basis, and then we would just do one entry per hour. We'd price it on an hour. So we take the hour close, like all the Bitcoin you got for that 1 hour, the price for that 1 hour, turn that into an hourly, like a fair market value and a lot, or like a layer for that particular crypto.
Okay.
So that goes into your inventory. You're going to have two inventories. This is where it gets really, really complicated.
Let's get into this.
As if we haven't yet made it inventory complicated. So first of all, you're creating a US GAAP inventory. So you're going to take that one Bitcoin. The way we work is that we give it the ID of the transaction on the blockchain. That becomes the inventory ID. So it goes into your US GAAP inventory. Your US GAAP inventory can be impaired, right? So you're running intangible asset treatment on your US GAAP inventory, so you can impair that down. So it goes in with a carrying value of $20,000, but if Bitcoin goes to $18,000 tomorrow, we're going to create an impairment action. We pick up a $2,000 impairment, and the carrying value of that inventory item goes down to $18,000. With me so far?
Yep. And you're journaling the impairment loss.
That would be part of your US GAAP adjusting ledger. So that would be, that impairment is US GAAP adjusting. And then when I sell that Bitcoin, we then pick up a realized gain that is going to be the contra of the impairment plus whatever the new price is. So let's say we sell it for $21,000. You'll then see your adjusting ledger for US GAAP will have a negative 2,000, credit 2,000 impairment, and then a realized of 3,000 that gets put in there. So that's your US GAAP adjusting ledger. You then also have a tax adjusting ledger. So on your tax adjusting ledger, you're not doing impairment. The cost basis is the cost basis is the cost basis. So in that same transaction that when I sold that Bitcoin, whereas my US GAAP adjusting ledger picks up 2,000 impairment, 3,000 realized, my tax ledger just picks up a 1,000 realized. So that's what Bitcoin is doing behind the scenes. And this, I don't normally go into this much detail. You guys are getting this special because this is an accounting podcast.
Yeah, debits and credits, man.
We're picking up a base ledger that's debits and credits of the book cost of the action. So debit digital assets 20,000, credit sales, debit or credit digital assets 21,000, debit marketing expense, whatever it is. And then the adjusting ledger is how you get between all those numbers.
Got it. I feel like that's the only good explanation I've ever gotten of this on a podcast. So thank you so much, Pat.
That's what we did something similar to this on our CPA Academy a long time ago. Before I joined, he and I did one, and he goes really deep into it, where we had to cut it off really quickly.
Pull back, buddy. Like pull out the spin here. We're going too deep.
So now you've pushed it on my ledger as an asset. I'm tracking. So now I'm ready to convert that to cash.
Yep.
All right. So I may do that in the app itself. It gets deposited in my bank account. Now, are you watching the wallet and you're going to go enter the journal entry for me to my bank account, or do I have to?
So the way that we work, and we have different ways we can set up the system. The way we work by default is that we're actually going to track all of your digital assets and cash equivalents. So if you have a Coinbase account, we're going to track that in Bitwave, so that when you do that trade, trades don't hit your book. It's one of the ways that we what we're trying to do is we're trying to make your life a little bit better on this stuff, because it's really hard. Like, as you're hearing me talk about this, there's obviously a lot of nonsense that you're doing to kind of handle this. And so we try not to. So a trade, if you're capitalizing fees, a trade is actually net neutral to the primary ledger, to your general ledger, because it is, you capitalize the fee into it, that stays within the cost basis, all that kind of stuff. So we actually tend not to push trade data and stuff like that up, but we're tracking that in Bitwave. So we know all of your balances, we know all of your minute by minute balances after all the trades and all that kind of stuff. It might not hit NetSuite, but it'll be in Bitwave.
Got it.
So there's one other thing I want to nerd out with you on, which is the NFT aspect of your business.
That's the best.
Because Dave and I were talking before we started recording, before you guys showed up, and we were thinking, well, why do you need to track NFTs? Because once I sell them, I don't own them anymore. Why? It's not the same.
Yeah.
So why would I?
Well, there's a few different reasons. So first of all, we work with a few customers that are NFT collectors and traders. So they are buying NFTs for a cost basis, selling them for a different cost basis, and picking up some sort of like realized gain or loss on that.
Okay.
So that's day one. For someone like if you are an OpenSea, you probably don't care about NFTs at all. You are not really inventorying NFTs. You're not really tracking them. When an inventory changes hands, it's a direct user-to-user trade. You're somewhere in the mix there because you're getting a fee off of that, but the NFT never hits your wallet, so you don't really care about it. If you're a minter, you might there are some interesting use cases people have talked about where you could, if you mint NFTs to a wallet and then you sell them piecemeal, you can kind of make an argument that you could capitalize kind of the way, well, it wouldn't be capitalizing at that point, but if you think about the way artists work, you buy your paints, you buy all this stuff. So you have a cost of goods and then you sell your painting, and there's ways you could treat it where you do a cost of goods against the revenue coming off of that. So there's reasons to track it for those purposes. Like if you want to track your COGS against your actual revenue off of it. But the real reason would be people who are collecting NFTs. Like they or are even, there's even one edge case too that I'll mention, which is if you're a gaming company and someone like imagine a kid buys a $100,000 sword and then his dad's like, oh hell no. So you have to buy that sword back. So you now actually do have a $100,000 sword sitting in your treasury, kind of whether you wanted to or not. So you do end up in these situations like that.
No, thank you. That makes a lot more sense.
And you have some of these larger companies that are customers of ours that have the NFT marketplaces, right? So that's
they're often they will often do that where someone, even though they're not the middlemen per se, if someone buys something that they did not intend to, they'll give them a refund and then they'll buy the NFT, and then suddenly you have an NFT on your balance sheet, kind of whether you wanted to or not.
And personally, I'm just dreading the day my 7-year-old figures out how to buy NFTs, because it's all he wants to do is spend money on Roblox.
Yeah,
it's already been happening.
As I was saying, he's already doing. If you're spending money on Roblox, it's already happening. It's just, just not quite the same currency yet.
Not yet. Well, hey, thanks guys for coming. Really appreciate having you, Pat, Raf. Where can people find out more about Bitwave, follow you online?
Yeah, absolutely. So a couple things. So bitwave.io, that's the easiest one. If you are interested in this at all, one of the places I always point you to is we have a maturity model that we publish that's called the Digital Asset Maturity Model. So bitwave.io/DAMM, damn, it's an easy way to remember it. That just walks through, it's a 4-step process for it starts with the CTO at my company had a fever dream and bought, a bunch of ETH on his credit card. What the hell do we do? Through step number 4 is, hey, we are an organization running a sophisticated DeFi operation and we're taking down the banks one step at a time, and that's us. So it's all the different stuff that's going to come up from a treasury perspective, from an internal accounting perspective, from a tax perspective, from a controls and operations. We didn't get into this, but one of the ways that Bitwave looks at the world is that you as a business, when you bring digital assets on, every part of the CFO office is touched by that. The controllership is touched by that, taxes, financial operations, treasury, all of these different parts. So we end up having a lot of solutions around there. So the digital asset maturity model is a great place. If you are curious about this and you're wondering what the next 5-10 years are going to look like, it's a great place to kind of get into to learn about it. I'm on Twitter. I'm at Pat White. I don't really tweet, so I don't know. But if you want to say hi, feel free.
Don't at me.
Yeah, right? don't. You can. I mean, it's just not. It's not very interesting. But bitwave.io and the other thing I'll plug is we have a Bitwave channel on YouTube. So if you enjoyed this, we do this kind of thing on our Bitwave channel. We do webinars and just general things talking about how, because we didn't even talk about DeFi. We did the 100 level stuff here. When you start talking about DeFi, you get so deep in this craziness so quickly. It's not even funny. So we have a whole thing about how to do DeFi accounting, all that. So.
Yeah, we work constantly with the largest firms, and Armanino very well.
Yep.
We're actually doing a session with them at another conference coming up, but one just specifically with them on wallet hygiene and really looking deep on level 1, level 2 blockchains.
Wallet hygiene.
It's really, really interesting. So we make sure, to make, from an integrity standpoint, that we're doing the right things in our product. We're constantly having meetings with, these large firms to making sure, that we know what's going on with the SEC, how we're treating it. They're asking for our advice. So it's a really supportive community, which I love.
Wallet hygiene was a term that I think we coined it. I don't think anyone else did, but it's this idea. So one of the things about thinking about crypto,
The term should be an NFT.
it should be. We should get that. We should definitely get that. One of the things about so the difference between crypto and bank accounts, there's a lot of them, obviously. But when you do a vendor transaction in your bank account, you get a nice little memo line that says like, I just bought a burger from Burger King, or like Burger King $5. You don't get that in crypto, right? You see an address and an amount, and that's it. So you either have to be really good at record keeping, which some people are, some people aren't. We have some tools to help with that. Or you can go the other direction where you have really good wallet hygiene, which is you have a wallet where all your revenue hits. You have a wallet where you pay all your contractor expenses. You have another wallet where you pay all your fees for your NFT trading, whatever it is. That way you can make your accountant's life a lot easier because they know, hey, if something happened, if I spent 5 Bitcoin in this wallet, that's a contractor expense. If I spend it in this one, it's a fee.
All right, so I'm going to repeat what you just said.
Yep.
So one of the greatest things of cloud accounting is the bank feeds.
Yeah.
And so now
We're getting rid of
getting
those.
super progressive, and basically you've ruined the bank feed.
Yeah.
And so because of that, you're going to be like, hey, go create a bunch of individual wallets so you get the same experience you get currently in bank feeds.
Yep.
Jesus, you guys are a mess, man. All this, you guys are not making the world any better. I honestly believe
There's a
this.
lot of cool stuff happening around here to like fix it. This is part of it is that there's a lot of stuff happening around this to fix this. And this even gets into what we're talking about. Like ideologically, the crypto came about because people wanted that pseudo-anonymity. This was an early feature of crypto, not a bug. But now where we are, where people don't want that, you're actually now finding people come up with clever solutions for digital identity so that you actually can get that bank feedback with potentially even more information in it. So we'll get there eventually. I
could see where it could be an extra perfect bank feed, right? It would be perfect.
Yeah.
Bank feeds coming in eventually because you could control the data coming through there, but
Exactly.
We can hope. We can dream.
It'll get
2
there.
steps back first. All right.
Yeah, it is. It's exactly right. It's because it's trying to adapt a currency design for pseudonymity for accounting, and then now everyone's like, "Oh crap, we kind of maybe should have thought of that beforehand." And now people are working on really cool stuff. It's normal evolution of technology.
And so the term is wallet
hygiene.
Wallet hygiene is
Keeping
the
your
new
wallets
bank
clean.
feeds. That's the new. We're gonna make that as a sticker.
I like it.
Wallet hygiene.
Perhaps
is the new
that
bank
is
feeds.
that could be the name of this episode.
So, someone like Plaid is actually working on this right now. So
Okay.
yeah, they're
That's good.
They're cutting edge on this.
Good. Thank you, Pat. Thank you, Raphael. Appreciate having you on the show.
Spectacular. It was our
guys.
pleasure. Thank you so much.
Appreciate
for having
it.
us.
Thanks, guys.